The stock market is overvalued. P ratio is so high, it's telling us it's 1999 all over again. So what you should do, stop investing, wait. Well, you know what? I found a few stocks that are not only great, but are actually trading at a very low P ratio. My name is Mike.TO, founder of Dividend Stocks Rocks, passionate investor. Welcome to this YouTube channel about 4 companies that are trading at a forward P ratio under 15. So while the overall market is trading at an all-time high and it's really hard to find undervalued stock here, well, there are some companies that are not getting loved right now. And today we're going to look at their business model, their dividend triangle, why they are not getting any more love from the market, and what could change moving forward. So let's start with number 1, no particular order, obviously, Lockheed Martin. P ratio for the upcoming 12 months is around 13, which is quite low. So, Lockheed Martin is a defense aerospace company, well known for its F-35 jets, the largest and most lucrative contract ever in the military business. They're doing missile and fire controls, all tech, military upgrades and so on, and basically they have one big client that is the US government. When we look at the dividend triangle, we see something that is just incredibly strong. Over the past 5 years, we see revenue going up, earnings going up, and dividend increasing all the time. Even better, just recently, a couple of weeks ago, management announced another dividend increase of 7.7%. So the new dividend payment will be $2.80 a share. We're talking about a yield slightly over 3%, which is kind of cool especially for a company that has been growing for the past 5 years on that steady pace. Very interesting, but the stock doesn't get any love. How come is that? Well, first and foremost, we're scared of a potential recession, and budget spending are through the roof for many years now. The COVID didn't help. So a lot of investors are saying, you know what, US government will have to stop spending that much money everywhere, right? We now talk about potential of budget sequestration. And we remember what happened back in 2012 when government had to stop the spending in few places. All the defense military stocks, including Lockheed Martin, saw their revenue plummet. They were not getting much new contracts. It was really hard, and they had to went back on their drawing boards, making sure that they control their expenses, improve their margins, and they set up the tone for the past 5 to 10 years, where the company eventually got back more contract, more revenue, and then since margins were healthy, earnings were through the roof. We are approaching maybe another potential crisis for the budget right now. Competition is still very tough. There's high barrier to entry in this space. Obviously, you're not talking about 10,000 competitors, but the mergers between Raytheon and United Technology could still put some brakes on Lockheed Martin's growth. They are also stuck with a heavy pension plan, and from time to time it will hurt their earnings because they have to invest a little bit more in it. So far for the past few years, it has been good because the market has been quite generous with us, but assuming that we're getting into a correction at one point, the problem will be that the pension plan will be an additional burden for earnings growth. So overall, we understand why the stock is getting sideways right now, not getting much love. What could change moving forward? Well, first, they have huge backlog orders. So the company is counting on billions and billions for the next 10 years. You can see that the growth will be assured for a certain amount of time. They're still dominating the market with their F-35. There's still some the cost control issues from time to time for Lockheed Martin around the F-35, but so far it remains the largest and most lucrative contract ever in this industry. Finally, Keep in mind that the military industry is usually highly cyclical. So now we're entering into a downtrend. This could be a good time to start grabbing some shares. Full disclaimer, I do have Lockheed Martin in my portfolio, and it's been quite a while. Now, moving on to number 2, ViacomCBS. This one is a little bit of a speculative play. We're going to talk about that in a second. The business model is quite simple. We're talking about cable networks, entertainment, so TV, cable, and movies. Movies under Paramount. They also have now interesting streaming businesses coming up. It's pretty much the same narrative around all the content and media businesses. They all have to move towards the streaming service, mostly because a lot of customers are cutting down cables, and this is one of the reasons why Viacom is not getting much love, but we're going to get there in a second. First, let's look at the dividend triangle. As you can see, dividend triangle, not as strong as Lockheed Martin, actually not strong at all. It's a lot shaky. Revenue are stagnating. Obviously, 2020 with the pandemic didn't help because a lot of advertisers cut their spending. A lot of people stopped watching TV and they moved towards other platforms. So, and it requires a lot of investment for them to invest in their streaming platform to follow customers. So earnings and earnings and revenue aren't doing that well. And then when we look at the dividend, it's not exactly what I look at as a dividend growth investor. So then you're gonna tell me, well, Mike, why in the world are you offering this one as your undervalued pick? Well, first, the forward PE ratio is around 10, which is incredibly low right now. And that is one of the reasons why I think it could be a very interesting play, but it's still highly speculative. One of the reasons why the company doesn't get any more love right now on top of customer cutting cable is that we had this incredible peak, and you can see it on the graph, where some hedge funds got margin calls on it, and then they had to sell all their shares. So the stock has kind of like a bad aura right now, where a lot of major institutional investors just decided to drop their shares as the stock plummeted. The thing happened as well because the company issued a lot of shares when the stock price was high. So it was a smart play from management because they got a lot more money from it. But at the same time, it kind of like push the value down, diluted the value, and then there was the margin call on those hedge funds. And this is the story behind why Viacom is not getting any more love right now. So what could change moving forward? Well, actually, the company is generating a lot of cash flow. They had a lot of money that came in also from this share issuance at I think it was $85. So now the stock is trading around $40. So you can imagine how they have generating a lot of cash right now to invest in their streaming platform. It's doing well. They're moving a lot of content on it. And the overall idea here, and I think that this is what's going to happen moving forward, and I've seen that in the past. You remember when you used to pay $100 for your cable? Now you cut down, and then you got Netflix, and then you were just happy to pay $15 or $10 or $20 a month. And then you found, oh my God, I'm going to get HBO because there's some series over there that I like. So there you go, a little bit more money now to AT&T. And then you look at it and say, oh, now I want Showtime, or I want to see Paramount movies and so on. And then I'm going to subscribe also to Viacom, and you probably put Disney Plus in the mix or Amazon Prime. So now you're getting back to that $100 a month in cable. Now it's just $100 in streaming. And this is pretty much what's happening in the industry right now. Viacom also broadcasts a lot of sports, which is a good thing because people love to watch live sports. Now that the pandemic is slowing down, it's getting under control, we can hope that we're going to get regular games for pretty much all sports moving forward as well. And I think that the biggest point here is after a few quarters, maybe a couple of years, you have to be patient on this one because it's still, again, I have to highlight it, speculative play. Right now, I don't think that Viacom is getting the love it should get. It is valued at a very attractive price in terms of price earning ratio. And moving forwards, I believe that with the cash they are generating and the growth they're getting from streaming, I'm pretty sure they can get out of this and then put back the company on a track with a positive narrative. If this happens, you're going to get some plus value in your portfolio. Again, full disclaimer, this one is also in my portfolio. Now let's move back to Canada. Interesting play here with TD. You know that I love Canadian banks. I keep doing those videos. You can see them in the link description. I do a quarterly review of their earnings. I have my top ranking. TD is usually at number 3 out of 6. My favorite ones are still National Bank and Royal Bank, but TD right now is kind of very interesting in terms of PE ratio, and this is the reason why we look at it today. Right now it's valued around 11 times their earnings, so it's lagging a little bit behind over the average for Canadian banks. I've highlighted that in my quarterly earnings. What I like about TD in their business models is that they keep things simple. You know, it's a classic savings and loans bank. They do some wealth management, obviously, in capital market, but they are quite conservative in their loan portfolio, and they know what they do and they do it right. So 2/3 Canadian, 1/3 US, so you can benefit from growth on both borders. So that's quite interesting. When you look at the dividend triangle, you can see that yes, it got hurt by the pandemic, but now it's going back on the growth path for both revenues and earnings. Obviously, dividend is not moving right now, but that's due to regulators. OSFI haven't put the I've put the brake on dividend growth last year. There's still some pressure to see banks increasing their dividend, but regulators said no, not right now. So we still have to wait. But the dividend is not at risk. We know it's going to keep increasing as soon as they get the go because they are generating a lot of cash right now. Their capital ratio are very strong, among the best among Canadian banks. So they're ready for a for a dividend increase. So if everything is pinky and rosy, what's going on with TD? How come it's not getting that much love and it's still lagging behind other Canadian banks? Well, global fear around potential recession. Obviously, we look at the housing market in Canada and we're just thinking, oh my God, the bubble is going to burst. Mind you, we've been thinking that for a while and it's not happening yet. So all of those fears, especially towards a company that is a classic savings and loans, could definitely slow down their growth moving forward. TD will have to grow through more acquisition if they want to pursue a little bit more growth, because I don't think that we're going to see loan portfolio and deposits going that high in double digits or so on for a long time. At one point or another, interest rates are going to start rising and it's going to put some brakes over there at the same time. Rising interest rates is a double-edged sword. On one side, it's going to slow down a little bit the economy. It could put some pressure on consumers, but it's also one of the reasons why TD could change and turn the tide around. With higher interest rates, you're going to get better interest rate spread margin. And if margins are better for banks, well, they make more money with their loan portfolio. Since TD is quite conservative and they are known for their very good underwriting when they issue loans, I am pretty much sure they will not get hurt that much if there's a housing crisis and then people start to lose their house. They're known for managing their business simple and keeping things straight. They've done that in the past. They went through the financial crisis back in 2008 in a very good way. So I'm not too worried about this point either. I just think that right now it's a good timing to buy one of the best banks. Obviously, I still prefer National Bank and Royal, but TD could be quite interesting to put in that mix. And now let's close down with Magna International, a very popular company. And a company that is been going down big time recently, and a lot of investors at DSR sending me emails like, yeah, Mike, we know that you have it in your portfolio. So what do you think? What's going to happen? The stock was way above $100 and now it's going down like almost every single day. What's up with Magna International? So first, Magna International, it's one of the largest auto part makers in the world. They are specialized with light vehicles. They have signed multiple contracts with electric vehicles, but they still depend on the big three from Detroit, where 40% of the revenues are coming from. They make so many different auto parts that they could actually start their own car company and start making cars. That's going to give you an idea of how dominant they are in their market. So if we look at their dividend triangle, we can see that they were struggling a little bit before the pandemic, like revenues were slowing down. There was a fear of a recession around the car industry, especially for the non-electric cars. All the love was going towards Tesla and the likes. You can see that earnings is going back to previous level, but the pandemic have a huge hit. Another reason why the stock is not getting much love right now is mostly because the market is concerned about the chip shortage. Since we had the pandemic, a lot of chip makers had to pause their facilities. They stopped making chips and other technology support for cars, and then car makers stopped also their orders, and now that creates a huge lag, and there's a problem here. There's a huge shortage. So there's a lot of new cars that are not getting built right now because we're missing chips. Therefore, Magna International will see their revenue stagnate, probably go down for the rest of 2021, most likely for 2022 as well. It's going to take a while before it recovers from this market event, which is completely out of their control. So when you put those two things together, and again, the fear of a potential recession at one point, if there's a recession, you know that the car industry is highly cyclical. So Magna International is going to take a hit. Backlog orders are going to shrink, and then the market doesn't like it. One of the reasons I can see as well is the fact that the stock price like skyrocketed since the pandemic, and maybe it went just too high too fast, and that is one reason that could be source of a concern for people that just bought it at like $125, and now they see it heading down towards 90, and there's kind of like don't feel that good. So what could change moving forward? Well, what I see right now is I see market events, I see threats that are all short term. We're not going to stop buying cars forever. The electric vehicles are still going to grow, and also light vehicles as well, because you know when you're focused on efficiencies, you're going to go either with electric cars or lighter vehicles, and Magna International is well implemented there. They have built incredibly strong bond with their clients, so automakers. And the thing is, when both parties spend so much time and energy to build platforms and parts together, they're not going to shop around and then pick another supplier anytime soon. So Magna International will likely remain a leader in this industry, and they will eventually see chips coming in, more orders coming in, and then they're going to surf that ride once again. One thing I've noticed over the past few months is that investors in general have become not patient at all. If you buy a stock and it drops by 20%, maybe it's just because it was on a super skyrocket time high, and then there's some profit taken. It doesn't mean that you made a bad investment. You're not supposed to expect a stock to outperform double digit all the time, especially like a few months or even a year after you purchase it. Sometimes it's going to take 1 year, 2 years, 3 years to finally generate returns in your portfolio, and that's totally fine because you're in it for the long run. A lot of investors tend to forget about that because right now it seems that everything is easy, right? You buy Bitcoins, it doubles overnight. You buy oil and gas stocks, it goes like 3 times, 4 times since their bottom of last year. So you have this impression that investing is pretty much like I put $1 in and I get $2 back within a few months. So whenever I put $1 in and then there's 75 cents back after 3 months, I'm going to start screaming and then selling and being angry. That's not the point. The point is, remember why you buy the stock in the first place. Look at your investment thesis. For Magna International, it's a perfect example. The company hasn't changed much right now. It's just following the cycle of the market. So right now, you have like some dark clouds over their heads. Obviously, the stock price goes down because it went on a hype right before that. And you just have to be patient a little bit, and then it's going to go back up as soon as the company can show more growth and the narrative around the stock change. Then the company will get more love. If you want to have more support when you build your portfolio and you want to learn about more on how sector allocation can play a big role on how stock selection and writing down your investment thesis and which kind of numbers you should look at, well then, download this free guide. It's my DSR recession workbook. We have built that in 2020 to help investors invest with more conviction, build a straightforward investing process. It's completely free. Links is right there below. You go on DSR page, you click on get my free book, and there you go. You're gonna download it. It's like 35 pages full of great content, and it's being updated every single year. So we had a fresh version that was written this summer, and I think that right now is definitely the perfect timing for you to download the book, read it. There's a bunch of questions that we're going to help you think about how to invest, and I'm pretty sure it's going to help you out with your portfolio, especially right now that we live a little bit more fluctuation and volatility these days. So hope that you have enjoyed this video. Give me a thumbs up, and I'm curious, let me know which kind of stock right now do you think it's undervalued. Maybe you have found other hidden gems, and let's share that among our community. So don't forget to follow my YouTube channel as well, subscribe, and every Thursday we're going to have a new video. And until the next one, stay invested.